Recording in progress.
Hey, all right, everybody. Good morning. Good morning. So yesterday kind of gave us a little bit more than was expected. Can't really complain. I mean, it would take what we can get. Still haven't got the message though, I would say. Right? It seems right now the Fed has tried to strip away everything with one clear overriding drum beating message. And bonds have certainly got it, right? Seems to be taking the message well. Equities, though, yeah, maybe not so much. Morgan Stanley and Barclays are getting sued for manipulating the VIX. Ha! That ought to be interesting. Most certainly. Right. Finance juice. This is where I like to start the morning. It's not the only place out there, especially if you've got paid services. But for a free service, this is a really good place to start the morning. The idea is we're trying to figure out what happened around the world, kind of get an idea if there's going to be any contagion, anything from, say, the European markets that are going to bleed over into our markets. It's always a really good idea to know who's open around the world and who's not. For an example, most of us Americans, we're pretty ignorant about everybody else's holidays, right? So, Europe could be on holiday, Asia could be on holiday, and that's a lack of participation, right? So it's always a really good idea to keep track of national holidays around the world, especially for the big players, the Asian markets, the European markets. There are rate decisions happening all around the world this week, and it's not much of a surprise. I mean, I think that, like we just talked about a minute ago, the message is pretty clear across the board. But that's the idea of kind of focusing on surprises, right? If we all had it figured out, we wouldn't be surprised. We have two ECB members on the docket today to speak. These are not market time, so make sure you look up your own time frame to understand when these speakers are going to be out there. We also are going to be getting housing data today, and it's a big one. Over the weekend, I like to listen to Seeking Alpha's stocks to watch. The name keeps changing. It used to be something like Wall Street Breakfast, or anyways, it's a podcast done on the weekends by Seeking Alpha. Look for it for this last weekend. There was a whole host of things going on this week. I was listening to it while I was cruising around on my bike, so I didn't write down any of the investor events, but some of them got my attention, and I had intended, and I still intend, to go back and re-listen to it, take a couple notes. It would definitely be worth listening to. Right now, everybody's looking at FOMC, but that's not the only thing on the docket this week. So maybe circle back, and it's a free podcast, right? It's you get what you pay for. If you already have a subscription to some place like Seeking Alpha, you could get much more detailed information. But even the free one, just listening to their podcast, it's a short little broadcast, like maybe 20-30 minutes. It's worth listening to. It's a part of my Sunday routine to go over and listen to that. Nothing else really stands out here that I think we need to cover for this morning. Just make it a habit of finding an aggregate news source from around the world to kind of get an idea of what's happening out there. Canada's got CPI, and then after that, we've got our housing permits. We do have an auction at 11. It's a 4-week. Not expecting too much out of this, but yeah, there's always that but, right? So Um, yeah, I mean, we'll just leave that there, right? So 11 o'clock, additional auction. Anticipate that if we're sideways, we could break out. If we've been trending, it could reverse. Look for a complete and absolute change of market behavior. If it doesn't really kick off, say by 11:15 or 11:20, then okay, you know that additional auction really isn't going to reverberate through the rest of the market. Kind of just shrug it off and move on. We are inside week. Not much of a surprise until we get the FOMC announcement, which the Fed Whisperer, which is some guy or some Twitter handle that the Fed likes to use when they want to get the word out without getting the word out, has come out and made the statement that it's going to be 75. I don't think that's much of a surprise, right? We've all been watching the Fed tool. It went from a 25, possibly 50, to no, it went from a 50-75 to a 75-100, right? And the 100 was a possibility. It was on the table for a little bit. Because it was on the table and they were starting to price that a little bit, we could see a little bit of a bump, a continuation bump from yesterday when they started to unwind from 100 to 75. I don't think that was a really good idea, but I believe that's what we were seeing yesterday afternoon. Could see a little bit more of that. Otherwise, we're expecting to pretty much toe the line, stay stable, maintain range until the FOMC comes out, and then whatever we get from there. His tone very much is going to be more in focus than what he's going to say. Right? The market's going to be listening for any kind of softening, right? So it's all about the hawks and doves. Looking through some of the data yesterday, it seems like maybe we're going to get to 4.5 before they decide they're going to stop. So it could be another 75 in November. And I would start watching the Fed Fund tool for the November and December to see how the numbers start to change out there. We are in a bit of a megaphone pattern. It's from the strategy, the Strat. If you want to check that out on YouTube. It is important to note when we're on the daily that we are continuing to get these lower lows and lower highs. It's the very definition of trend, right? And that we would anticipate another lower high. When you kind of look at the distance required to set a higher high at this point without first flipping over again, it's a pretty high benchmark. Now, it's possible to do, right? We don't want to say that it can't do that. It's just unlikely to do that. We're still on the daily chart. I just added a bunch of junk. So, it's a little bit cluttered, and I apologize for that. But we want to look at the moving averages. Normally, I'd keep them separate so we wouldn't have to see all of them at once, but we're trying to save a little bit of time. The white one is below the 10. So it's like a 4-10 pair, or I might have set it to a 5, but it's something like that. It's a really low numbered moving average. 4-10 pair is what we use for surge. We're underneath the 10. Price is underneath the 4. So a bit of a rejection. You want to plot those on the intraday, see how price interacts with those daily moving averages. We've got a beautiful fan spread out between the 50, the 20, the 10, the 4. They're just really nicely spread out. This isn't looking like it's going to slow down anytime soon. Of course, no amount of technical analysis is going to give us an idea of, the scope of the move when FOMC data finally does come out. Come out to look at this daily to see, hey, are we going to hit anything today? We will if we start to go back up. If we attempt to break through yesterday's high, we're going to yet again interact with that 4-period moving average. That's really all we need to know. If we continue to go to the downside, there's no moving averages down there to interact with. Good enough. That's all we needed to really see there. We step back a little bit and kind of ask, well, how far away from that 10-period moving average are we, and have we moved too far? Nope. We're sitting at around 2.6. Reversals seem to be coming in at around 4.5 to 5 on average. So we have not moved too far too fast. We're still well within the boundaries of what would be considered normal. Now, this is for the week, the 10-week. So let's flip this and check out the 10-day. Make sure we're not getting too far away from that 10-day moving average. We're sitting at a 1.4. The flip seems to be around 2.5, maybe closer to 3. So again, not too far away from the 10-period moving average. So we're not moving too far or too fast. Volume's in line. That's the lower indicator here. It's cumulative volume only in the overnight hours. It's just a benchmark, a snapshot in time. Tend to look at this every single morning. We're looking for a lack of participation or an excessive amount of participation. We have neither one of those today, so we just go ahead and remove it. Get it out of the way. All right, I'm going to step back a little bit into the time frame, go a little higher out, just because it makes it easier for what we're about to do here. This is pretty much going to be the scope and the pace of things. I would even give it a little more room. Say 39.5, maybe 39.75, right around in there. It's very likely that we're going to just stay within this range, right? And the range can expand a little bit more. We can wick a little higher, we can always wick a little lower, but we're not expected to fundamentally change within the market structure before we get FOMC. So we can range around all over the place. That weekly pivot point would be a really good benchmark to kind of keep your eye on. 39.76, 39.75, right around in there. I really don't think we're going to expand beyond that until we get Wednesday afternoon. Right? And same thing for the downside. We could wick down a little lower than the current low. Maybe tag into 38.50 area. And it would still be considered, my thesis would still be that the range is going to hold. Now, it doesn't mean that there's no opportunity, right? I mean, there's always opportunity to trade. It's just the idea that, just like with yesterday, you're going to want to pick your opportunities. What I caught yesterday was this run up to VWAP, and I caught it with some confluence between what I was seeing in the dollar and what I was seeing over here. So it was a pretty good play. Be patient. Look for your opportunity, right? There's no reason to try to jump the gun and maybe get chewed up in some junk like this. For the intraday, keep your eye on the clock and just really try to focus on maybe a smaller pivot structure. So we have yesterday's high, low, close, Globex open, VWAP, our own Globex low, Globex high. We do have the ADR low within our range, so 38.81.5. that cash open from yesterday, 38.5. What I don't think we're going to be really flirting with today is an expansion to the upside. So the ADR half 39.64 and last week's, or excuse me, the weekly pivot at 39.76 and a full ADR above the 4,000 line. It's possible, I just don't see it. Now, I did mention we could continue to see a little bit of that bump if they're going to unwind from 75 from 100 basis points to 75, because it's pretty much confirmed at this point that it's going to be a 75. So anybody who had already started pricing in the 100 is likely to unwind that a little bit. When we're talking about watching the probabilities, this is what I'm referring to. Right now, we're at 225. We're looking at a 75 basis point increase, which would put us at 300. They were pricing in the possibility that we were going to get 100, so we were going to go from 225 to 325. So that 18%, if they begin to unwind that, that could cause a little bit of a pop in the market. You'll be able to see if they're done by looking down here. The bar itself is a snapshot in time. It really doesn't tell you where were we at, say, an hour ago, or where were we at yesterday. So that's why you got to use the graph down at the bottom. You can see the percentages. We're looking at 325 to 350. That would be this lowest column. It's sitting at 18. Yesterday it was sitting at 19. So they are starting to unwind it just a little bit, 1 percentage point. Look for that today to really begin to expand, going from 18, say, down below 10. When we see that, we could continue to see a little bit of a rally in the market. Remember, it's not going to be a sustainable rally, right? It's not like that July rally where we just ripped, right? It's not going to be that. All right, very, very wide volume profile. We're obviously inside the box. We've got a lot of trash overhead, which kind of fits into everything that we've been talking about, and a lack of follow through to the upside. To get that follow through, to be able to get above 4,000, or even just to get to 4,000, we would have to make it through the point of control and all of this trash. And without FOMC to do that drive, I don't see that we could do that. If we do get through there, say on the back side of Wednesday into Thursday morning, got a beautiful shallow area, very likely going to move through that very quickly. So if the market sees what comes out Wednesday is dovish, or they like what the Fed has to say, and we start moving to the upside and get through 4,000, we're very likely going to go to 41.5 very easy, right? Or at least 41.25, because that's where resistance starts to pick back up again in the volume zone. We move through shallow areas relatively quickly, or relatively easy. All right, 5-day, 5-minute chart. We do have a volume profile untouched below us, right? So we get this untouched point of control. You want to carry that forward until it is touched. We'll just take one from the other day. That one will do. All right. So you want to carry forward those points of control until we do actually come down and make contact with them. Then you can take it off. Like this volume point of control up here was an untouched point of control. It's been hit. We don't need that one on the docket anymore. Take that one off. But it did its job, right? And it was that point of control from last Thursday. We came up, we hit it. Now, technically, you could argue that those hits happened in the overnight hours, and we didn't necessarily like breach through it, get onto the other side of it, close above it on, say, a 30-minute or a 1 hour or even a daily time frame, and that wicking through doesn't count. I'm not making that argument. I'm just presenting that argument. When it comes to technical analysis, or yeah, OCR, technical, whichever way you want to go, when it comes to doing your analysis, the main thing is to be consistent. So if you subscribe to the idea that it doesn't count unless we close on the other side of it with a significant candle value, stick to that all the time. Don't get wishy-washy with it and say, okay, well, this time we hit it and I'm going to take it off, but next time, well, I want to see it go all the way through. There's also the argument about what time we hit it in the Globex versus in the regular trading hours. I've heard a lot of discussions on the concept that it doesn't necessarily count because it was a Globex and because we didn't close on the other side of it. We hit it. Price obviously responded there twice. And I can now just lean on the Globex overnight for the pivot that I want to focus on and no longer even concern myself with that previous point of control. So I take it off. But we do still have one underneath this based on yesterday's 38.86.75, right around in there, 86.5. Keep your eye on hurricane news. If they start shutting down the Gulf of Mexico and flying in non-essential personnel, you're likely to see energy start to get a bump in the market. There is a name to focus on. Someone way smarter than me pointed out that if we get a hurricane in the Gulf, there is an asset that is very likely going to take off. GNRC. So definitely worth putting that one on your radar, especially if we do actually get a hurricane in the Gulf. It's Fiona, right? I believe is the name of this. It seems to have ripped apart Puerto Rico pretty good. It seems like those guys can't just catch a break. I don't even think they were still... I don't think they had completely rebuilt from the last two hurricanes that kicked them real hard in the head. I don't have the link now, but there was a donations link being passed around to help those people over in Puerto Rico too. So take a look around. You know, if you feel a little charitable, maybe help someone who's in worse shape. So inside day in Bitcoin, bonds breaking lows. Again, it really seems like, you know, it seems like the bonds aren't done yet, not by any stretch of the imagination. And I look at the bonds a lot. I know a lot of other people like to look at yields, you know, the rising rates. And you can trade these without having to use those old school futures, by the way. The Smalls Exchange does offer the 2, the 10, the 30. You can trade the dollar instead of having to screw around with that ETF, the UUP. Every time I trade the UUP, I get assigned. Every time. It got to the point I don't even trade it anymore. I watch it, I'll look at it, I'll use it as a gauge, but I don't trade the UUP. I got tired of getting assigned all the time. I just trade in the smalls instead. They're still not as popular yet as I had expected them to be, but the popularity is growing. And I think one of the reasons that it's not as popular as I had expected is Bloomberg came out with their own version too, with the Fair X exchange. And that's another smaller futures product, more closely resembling options really than a futures product, but still futures, so no PDT. And the Bloomberg one, I gotta say, is definitely more liquid. They don't have a bond yet, but they do have small futures. It's worth looking into. So with the 10 or the 30, we want to see no big exaggerated movements, and we've been seeing those big exaggerated movements. This morning we had stocks and bonds moving in the same direction in this sell-off right here. So you really want to see these break apart again. Decouple, use whatever language you want. They're not normally moving in the same direction at the same time, but we know that it happens. The main thing is, when is it going to stop? So while you're watching through the trading day today, keep your eye on the bonds versus, say, the S&P, and look for these two to decouple. Since they're both sitting at the lows of this pretty good size leg down, look for, say, bonds to continue lower, but the S&P to not continue lower. Right? Say it starts going back up, or vice versa. Bonds start to go up, S&P continues lower. We really want to see these two break apart and go back to doing their own thing. The dollar is still holding around that 110. It's a massive, massive level, right? The line goes back for years and years. So not much of a surprise that we're going to see a lot of chop there. There's still the whole thing going on with the U.S. dollar Japan. When Bank of Japan, BOJ, came out and drew that line in the sand and kind of stomped their foot and said 145, that was it. So then we have dollar China coming back up, dollar Japan, dollar Europe. Like a little bit of a currency war going on right now. So keep your eye on either, watch the Dixie, the UUP, depending on where you're at in the world, you can watch the ICE dollar. Either way, just keep your eye on that sucker today. We don't want to see any big exaggerated movements. 110, kind of a line in the sand. We break that 110 and start heading to the upside. I see the S&P breaking below 3,800. All right, so it's kind of like that. With the VIX, the thing is still a turd. And with that article that came out this morning, or the announcement that there was heavy, heavy, heavy manipulation in the VIX by Barclays, and I've already forgotten the name of the other one. They're getting sued for manipulating the VIX. How you like that, right? So with that coming out, it was Morgan Stanley and Barclays. It kind of makes a little bit of sense of those moves we've been seeing in the VIX this year, and sometimes the lack of move in the VIX this year. So we'll have to see how that goes. There really isn't any reason to dig deep into stocks at this point until we get FOMC. Attempting to trade stocks on a swing trade basis through this, nah, I wouldn't even want to encourage it. So with that, everybody have a good morning. Be safe. I will see you all tomorrow.
Recording